There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits, or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Welcome, Auvorians and traders of the world, to the Saturday. My name is Steve Vetterl. I am the Auvoria Prime CMA. I'm also the owner, along with my partner, Steve Ruff, of a firm called First Down Financial. We are located in Oviedo, Florida. We're a nationwide insurance broker and investment advisor. So I always try to put these podcasts, and in this case, we'll do a sort of like a pod/video casts on Saturdays and Tuesdays. I did not get a chance to do it Tuesday, so if you're looking for that cast, that was entirely my fault. Working hard. There's do keep in mind when you guys are looking for Forex Factory news, it's just forexfactory.com. And always make sure to change the state, right? You always want to look forward to the next week, reflect upon the previous week, but I always suggest moving to the next week. You can go in and do a, just remove the orange folder and the yellow folder, and then have a more clear view of red impact events only, right? So, next week, which is Monday, October 31st, keep in mind this is, in many cases, the last day of the fiscal year for many mutual funds, okay? So as those that point the fingers to particular events that may have pushed markets one way or another, you'd think watching the financial media we're in a brand new bull market, but there is a tremendous amount of juxtapositioning going on towards the end of October. Why? Because it's the annual reporting for mutual funds, right? It's not a calendar year for many of them. And that can create the need, not necessarily the will, but the need to jostle portfolios around to make them look better. We call it window dressing in this industry. That does play a part in the volatility that typically will exist in equity markets, indexes, options, right? Which will all wave off into any type of currency pairs that are trading based off of an index, right? Or some symbol that one will trade on a Forex platform, primarily MT4, MT5. Now, I have a much broader audience listening to this cast, as we have a lot of clients at First Down. We have a lot of advisors that partner with us, maybe their clients, prospective clients, all kinds of stuff, students listening to this. So over the course of the last couple of years, I've broadened out what I talk about. It's really just include all markets. Obviously, I'm going into focus towards the end on currencies, but I think the format really just should be one of risk management, right? Going through the news stories of last week and what was pertinent. Most of it was fluff and crap, but I can point you towards the ones I feel were impactful. I would always encourage that in any pursuit of research that's based on any kind of trading you want to do or portfolio management of the markets, that you do it with people that you understand, not people that you are aligned with, right? I, for better or worse, in some cases worse, I have a fair amount of followers because I present this in a rather brash and I don't know, blatant type of format. I do that for a reason, right? One, I'm not looking for anybody to say you're our guru, because I'm not, right? Two, I want you to continue to follow people out there that are far smarter than myself. Okay, there's a lot of them out there. I follow a chunk of them on Twitter. And as we all know, throughout the course of the last week, ownership has changed at Twitter. I think that that's a positive without getting into the politics of one way or another. The real key to me in Twitter, it is a free, for the most part, tool that will allow you to not have to spend an inordinate amount of time doing research. Why? Because if you follow the right people and they truly are an unbiased, not hawking their book, whether that be some type of book that they wrote or their book of stocks and other investment portfolios that they're looking to unload while they're telling you that they're buying, right? So I follow a fair amount of people on Twitter. I think it's an excellent platform for research. There is a tremendous amount of collaboration that goes on in Twitter. All you really ever seem to hear about Twitter is all the trolling. Yes, that does exist. Yes, those that are posers on Twitter will get tortured a lot more, and it's just a general waste of everybody's time. But there are a number of people on Twitter that I follow, all in the billionaire range, that, in my opinion, offer excellent research, unbiased opinions, and it just helps you do less research, right? So if you got to spend less time on something from a research standpoint, you're spending less risk, right? But I would always encourage everybody, as I oftentimes see new traders get down the path of trying to find people that are aligned with their views. Don't do it. Always find somebody that either pisses you off or has an opposing view. Why? Because it's going to make you think. The more that you think, the more you're going to get better at doing research. And with that, that is my early Saturday diatribe of risk management. So let's get into the numbers. Next week, October 31st, again, it's the last single day of mutual funds. This is the end of their fiscal year. We have the RBA statement coming out on Tuesday. We've got the French and Italian bank holidays. I would imagine it'd be a little bit cooler in Euroland because of this. Keep in mind, anything that I show you that has anything to do with unemployment, just like you see down in New Zealand, right? Or anything that has to do with CPI, okay? I don't care if it's month over month, year over year, day over day, right? It's ridiculous. It doesn't exist. My point is to pay attention to anything that is consumer priced based. I don't care what country it's coming from. Hopefully, you're just looking at ones that are coming just from developed countries, because I think in the end, that is one of the most important things, is that you are looking at basically having a consumer price index situation that has a lot to do with developed markets only. Okay, so the tone, if you will, which I'm going to read through here in a second once I get through some of these news stories, is slightly changed last week. So pay particular attention to what they say at the Bank of England, right, next week, right? You have Governor Bailey speaking throughout the various events they have planned for the morning hours there. Do keep in mind the unemployment rate does play almost like a tertiary level in this particular case, but it's not something that I'm paying as much attention to. At some point, unemployment rates will be much, much more in focus, if you will, more in the crosshairs. Right now, really the only thing that matters, quite frankly, is the level of inflation. Primarily, I look to quarter over quarter, as well as year over year. You can always click on some of these if you guys want to do a deeper dive on these, but for those not trading, these events don't pose really any risk to your portfolio. But for those of you that are trading, never ever want to trade in front of a red folder event, in my opinion. So what took place last week? Well, we had the stock market made a show of strength by surging, despite a bunch of disappointing big tech earnings reports. It's really, honestly, it's still too early, in my opinion, for investors to get any excited with the Federal Reserve meeting rapidly approaching, obviously. So the NASDAQ had a 2.9% gain for the day, since on track to end October with a 5% gain, but it still is 27% under its high, right? And it still sits 1.9% under the key 50-day moving average. So this is a key resistance area to watch. Anybody that is trading based upon this, especially on the MT4, MT5, there's a number of indexes. These are instruments that can be traded in the Forex markets that mimic or replicate, if you will, the movements of a U.S. index, primarily S&P 500, the Dow, and the NASDAQ. That 2% rip, if it even happens, who knows, right? I could always be wrong. Up to that 50-day moving average, I would imagine is going to be met with a pretty significant amount of key resistance. So just keep that in mind. So S&P had a 2.5% gain for the day. And if you look at the spiders as a proxy, it's up 8.9% for the month. It's still off a little less than 20% for the year. Okay. So no surprise that regardless of what's changed in inflation or corporate earnings, right? It's certainly been better for some. It's been worse in the tech arena, especially for advertising-based tech. In the end, the key thing really is, are the Fed going to continue to raise interest rates or not? I mean, it's that simple. So if you want to cut all the fluff and crap out of everything that's coming out of the television or radio or computer at you, most of it is a complete waste of news, in my opinion. That's really it. So look at a couple of key indicators, follow some people that maybe can provide you some decent insight on that. But at the end of the day, it really is about whether inflation's going up or not. So let's see what else. I'll make comments here. I think some of this, although I certainly can't quantify this with any research, but it is typical up into an election. If there is going to be a changing of the guard, if you will, and again, try to keep this podcast in an omniscient point of view. We are neutral here. We don't give a rat's ass about the right or the left. We only care about the policies that each set and how it reflects and impacts markets, right? Again, risk management. Trying to get caught up in the mania of all of that. So the coming week will be pretty crucial with speculation, raising that the Federal Reserve may consider slowing the pace of hikes. So with that statement comes a whole bunch of tailwinds in that we don't know if they're actually going to do that, right? Market's betting on it. I got to believe there's tremendous pressure from the current, actually, let me go back and restream that. There's probably tremendous pressure on the Federal Reserve to have, let me just close all this stuff down. Back to this one I was going to show. So what you guys see in front of you is the Investopedia, what we call the PPT. Now, the markets have a lot of conspiracy theorists baked into the history of markets, okay? I'm just going to say that right now. Whether it's right, wrong, or indifferent, in the case of the PPT, there is enough proof, in my opinion, that it does exist. I'm not saying that the PPT was in working over the last 2 weeks, but let's just say if there was ever an opportunity for them to keep us from falling off the cliff, we were certainly able to do that at the end of September. I would say that they have successfully executed on that mandate, if you will. So, that being said, what's the plunge protection, Steve's team? Why do I care? So, just after the crash in '87, and yes, this is a risk management thing, even if you trade Forex, because after 1987, President Reagan who was the man, put in a president's group, essentially a working committee for financial markets. And you need to go all the way down here and get past all the stuff here, but a lot of people don't understand how this group may work. But through the futures markets, which has been proven, a number of Fed governors have sort of let this slip as to what, sort of how this group operates, at least in modern days. They can come in and support the markets. They usually do it via the big S&P contract in the pits, or electronically via the CME exchange, which is the futures markets. And during the financial crisis, I saw a tremendous amount of data during that March 6th month, during the whole month, I should say, of both March and April. Remember, the S&P got all the way down to 666 at the bottom before the PPT came in and started buying equities. Okay, so it is my opinion, right, wrong, or indifferent, based upon all the guys at Goldman I used to know, that the Federal Reserve and the president's sort of working group, we call them the PPT, the Plunge Protection Team, they basically came in and saved financial markets from an equity perspective, right? They have had a sordid history of supporting the markets. Whether you believe this or not is not important to me. What you do need to understand is that it can affect markets. Okay. This is not about, hey, let's have a podcast and get everybody on Steve's boat, right? Right. That's not important to me. The only thing that's important to me is that I teach you guys to fish off your own boat. I preach this to advisors all week. Many of them are like, yeah, I don't want to get this license and I don't want to get that. Can you help me with this? And, we're happy to help them, but we're not teaching them. Okay. You'll hear a lot of traders come in and say, well, I just want to copy trade you, right? I think that's the completely stupidest thing to do long term. You can use it to learn, but in the end, the best thing always is for you to build your own fishing boat instead of fishing off of somebody else's, right? You can learn off it. They can help you build the boat. There's many things that can be taken from that. But I still think when you're out there floating around by yourself, you're not needing anybody as a crutch for anything that you do. And this isn't applied to just financial markets. This is everything in life, right? Risk management comes from when you are educated and understand the pros and cons of any large amount of whatever that you're about to do. I'm not sure if it could certainly apply socially, personal relationships. It certainly can be very, very powerful in interpersonal communications. But in the financial markets, it helps you look at how you can be wrong, right? So one thing I did learn from Ken Fisher, with all his faults and his craziness, the man is a genius when it comes to portfolio management and the history of financial theory, right? And how it can be implemented practically and tactically to put together and actively manage a portfolio, right? That's what I did learn from him. And Ken is constantly saying, at least he was back in the day, I could always be wrong. So if in fact I'm wrong, and I'm clearly aware of I often can be wrong, you take a completely different mindset to approaching risk management, right? Instead of, right, and this, at least from the standpoint of anybody that is a mentor or a so-called guru out there in financial markets or teaching trading, the best ones out there are some of the most humble people that you'll ever meet. The worst traders out there, I don't care how many Lambos they video in their garage, right? Just mostly bullshit. If you walk around parading yourself as this expert and you're constantly calling out, hey, I called that one out, and yay, did you guys get on board? I bet you missed that one, right? It's not teaching you to fish, right? It's making you dependent on something. So with at least how the markets work, and obviously this is more of an equity-based discussion today, and that was by design. I just want everybody to understand that, there is, I don't care if you're trading the options markets or ETFs or just equities as an individual or in a group in a fund, or you're trading Forex, or you're trading some sort of futures markets and commodities, currencies arena. It's kind of the same thing on the CME. Every single thing that I talk about or chart for will apply to all of those markets. The key is just understanding where the levels are that carry significance, right? It's called confluence. But there's a lot of areas that are outside of technical analysis that are more of just news related or risk-based events that can take place as far as geopolitical, right? There's no way you can put those on a chart. So you have to understand how the human mind works, how your brain thinks, being able to control your inner monkey, right? At least some of you have heard me say this way too much, but one of my all-time favorite videos that is one of the best representations of risk management is in the late 70s, a suitcase company called Samsonite. You guys can look this up on YouTube. They would throw their suitcase in a cage with an absolute gorilla. I mean, like a 2,000-pound gorilla. And he'd be jumping up and down in the suitcase. He'd be beating it against the walls of it, but the suitcase never broke, right? And elite superstar traders, that is exactly how their mind works. They're being thrown all around the financial markets and the trading systems, but you can't break their focus. And I think it's one of the best examples out there. A little bit of comedy too. But if you can get yourself into that zone of, regardless of how you're tossed around, you can't be compromised or broken, you will be super successful in this industry. I don't care what field that you're entering into it. So, all that aside, let's get into the boring stuff. Charts. S&P, we had a huge day on Friday. Again, we are coming up on the end of October. Steve, is it related to the fact that it's a fiscal year end for funds? I don't know. What if I'm wrong and we're in a new bull market? We're going to rip to new highs. Well, that's not possible. If the Fed pivots, what do you think is going to happen? I mean, there's contrary to all the doomsdayers out there, there's still an absolute mountain of cash. It is almost uncountable of cash sloshing around this planet looking for a new home. Keep that in mind. New highs, that's not possible. What if it happens, right? Everybody's bearish. Now let's take the flip side. Let's say I'm completely wrong. What are we going to do to look to the downside? Let's take a look. Remember, the markets believe in what's called max pain. Max pain is bankrupting most individuals when they least expect it. That is the job, in my opinion, of financial markets, right? Outside of executing flawlessly and having no bias, right, which is part of the regulation involved. I think that from an emotional standpoint, if you are a trader that is constantly of that mindset, you're always protecting your pot of gold, right? You're not out there throwing the dice down the craps table, looking for a win every time, putting every piece of earnings on the table, because at some point you're going to roll those dice down the end of the table and you're going to come up with snake eyes. So all right, so I think a weekly chart of the S&P is in store here as well. Let's take a look at a full screen on this. I always like to take everything all the way up to the highs and then have to the lows so you can just get an entire view of what's going on. Now you're looking at approximately, just condense this down a bit. So you're seeing the pullbacks here in 19. You're obviously seeing here is the reaction off the pandemic. I mean, yes, quantitative tightening by the Fed was in. We, let's just say we at the firm took a lot of heat from many sources, not just clients, when we were ridiculously bullish at this point, like to the point where, like, you guys are completely crazy if you're sitting anywhere but stocks, right? A lot of people didn't believe us. We knew that there was going to be a backstop of the Fed. There was no choice. They had to come in and keep buying hand over fist. Was the plunge protection team active here? I think they were. Were they active here? Nope. Don't think they were. I think they were concerned. They've convened meetings over the years. It's not often, but it's usually during just absolute bananas periods of time like this right here, right? Those that bought and held had a tremendous return right up to the end of, well, actually here, the end of 21, right? Now, all of a sudden, big, bad, ugly inflation comes in, and what happens? We have pullbacks. Those that understand what a slingshot is, that I've talked about in the past, see how we slingshot it back up. Boom, back up. Every time you're coming back, right, you're taking these slingshots, at least if you're short, you're holding for a swing period of time. This is a slingshot short. This is a sling, right? Now, here's what's happening from a risk standpoint, right? Arguably, we've been in a bear market for 9 months. We are now rallying back to that potential pivot point, right? You can take a line, connect every one of these points, and drop it somewhere around this moving average, I would think, maybe just a bit higher. And that's potentially where we can rally to. What happens from that point? Remember, each one of these is a weekly candle, represents a single week. Let's see if I can drag this down and make it easier to see. Call me weird, but I like to look at this stuff in its entirety, like constantly. I always have this chart up in the office. I don't like looking at small time frames. I prefer a much larger time frame because it just puts a lot more stuff into perspective as far as not only order flow, but also anything related to technical analysis. So anybody that's trading any kind of index on MT4, which is a chunk of our Auvoria subscribers, some cases the algorithms of some of our developers and product guys have put together. They trade a lot of this stuff as well. So I always think it's a great way to sort of start. But regardless of the market that I put on you guys, if you're trading anything that has a high volume, active flow with good data, good liquidity, none of these chart patterns, no, I should say, all of these chart patterns will be applicable to all of those instruments, regardless of what you trade. So I just prefer to teach on an S&P or an ES-based futures chart because there is, in my opinion, a very, very quality stamp, if you will, on the data that's coming in to TradingView. Okay, or any of the good trading platforms out there like a Sierra Charts or a Ninja Trader or Trading Technologies. And there's a number of great chart platforms out there. Interactive Brokers has one as well. And there's also the more expensive ones like CQG, which is really good, or Bloomberg, the most expensive on the planet. In any case, so I would expect us, I don't know, seemed to me everything's going to really hint on whatever they say next week. If they continue on the path of, hey, we're going to tighten more, regardless of where, I mean, Powell's not going to come out next week and say that, but if we're going to tighten more over the course of the next quarter, then this was all for nothing. I think the markets go back down to the low. And if you notice, and now after our lesson on PPT today, you'll be hopefully thinking to yourself, well, geez, we get back down to 3,500 in the S&P, which basically is the edge of the cliff, in my opinion. Will the PPT step in and help? Will they not? Was everything Steve said today complete BS? I hope not, but you never know. What if I am wrong, right? Let's see else. Most of what I said applies with a little less of the rebound, if you will, in the NASDAQ markets. Yeah, I just noticed something. What the heck happened to the NASDAQ index? I deleted it. Oh my God, that's funny. By the way, here you guys go. Here's the US 30. A lot of the Auvoria subscribers actually trade this. I would argue, honestly, I would trade the S&P or the NASDAQ. It's just me. Look, everybody, you can trade whatever you want, right? But some trade the CFDs, some trade just the currency pairs. I don't know. I'm just biased, as many of you know, towards the NASDAQ and the S&P as far as trading. Interesting how the data provider changed on Nanda. That is interesting. I am, let's just say, ye of little faith when it comes to the quality of data coming in. My biggest fault, if you will, and it's hard to complain about software that costs 15 to 20 bucks a month, right? You really can't complain. But my biggest complaint, which is absolutely a risk management thing, somebody asked me what was like top 10 things. Somewhere in the top 3 would be, have a decent computer and real estate on your screen-based setup. Not as particular on that, but just make sure you have a quality system with good data and good speed and low latency, right? Meaning you're not going to get disrupted, right? Trading off of Wi-Fi, not smart in my opinion, right? I trade only off of an Ethernet direct cable connection. Just because it provides, and yes, look, I've heard all the arguments of, Wi-Fi 6, and I got this $600 Asus router with Wi-Fi 6, and I'm just still of the mindset, if you can be trading large capital, I will never be doing it wirelessly. And this is probably going to spin some heads on this podcast, but I'll tell you, I prefer a wired connection only. And I can tell you over the course of the last 20 years, most of those 20 have been on fiber hookups wherever I've traded, both in office and home setups. I can count on one hand the times that the internet from a fiber standpoint has been down. It's been due to some sort of large storm. But interesting enough, when Hurricane Ian came rolling through, the AT&T fiber that comes into both my office and home, we've got most of this area wired here in North Orlando, never even flickered, just not even a single disruption of the fiber line. So that's, it's a risk management thing. I believe in having a core system that is rocking, right? You don't have to have a $5,000 Corsair liquid cooled computer to do this, right? You don't have to have two 49-inch curved screens or, all this nutty real estate you see set up in terms of monitor configurations on YouTube. You don't need it. You can have a nice, couple of 27-inch screens to still accomplish the same thing, right? So it's not about that. It's just about quality of setup and product. And I'm on all kinds of diatribes today, huh? All right, let's get into currencies. Enough of the rambling on. There's my index. Looks like it got lost. Yeah. I prefer to have the index, by the way, right next to the ETF, right? Because it tells me any issues in changes, right? Sometimes, this really isn't a difference between these two, right? But these two right here, because this is the front month contract, but it's on what's called a continuous feed, as you can see here, right? We're on, and by the way, the D stands for delayed. So just know that. On my future systems, I have live real-time feeds coming in where I actually trade. But looking at these two, I always prefer to look at the ETF, and the 4 that you're looking at right here are the 4 most actively traded instruments in this entire planet. But I want to see any differences that can potentially pop up, right? Any dislocations, any uncorrelated activity. Why? Because it's showing me something's going crazy. Like when we had the flash crash going on, the quotes between the actual index, the composite and I'm probably just as much full faith and credit in the NASDAQ as I do anything on this planet, next to the CME index in terms of quality organization and data, right? That I do S&P. And if things are trading off between the two, that can bring some, I don't know, canary in the coal mine to your trading, right? Something's off. Typically, that dislocation, which is very, very rare historically, I mean, we're talking like high 99.999%, latency. So uptime's basically all the time. But during the flash crash and a couple other events over the last 10 years, we had some dislocations here. And had you been watching some of these, you would have caught it and more than likely been out of whatever you're trading before the melees hit the main market. Does that make sense? You usually have, at least in the past, probably about maybe 15 to 20 seconds to figure it out before it hits the rest of the market. Could be a lot less now. Okay, I've not talked about the dollar. 45 minutes in the broadcast. I haven't talked about the dollar. Why? Because we go back to a daily chart. I expected this to be stuck in a range. So 114, 115 on the high, 110 on the low. As markets rally, the dollar comes back. That is not always a perfect inverse correlation type relationship. Just remember that. That has been what's been happening the last couple of years. Markets rally, least developed markets rallying, dollar pulling back. Everything else going to complete hell, which was the case all the way through the summer. The dollar was going up. Dollar was about the only thing other than inflation that was going up. Everything else went down. So now that we are, and keep in mind, I disconnect commodities from this discussion because many of these commodities that sometimes you guys see I show, I'm not going to go into the dashboard today, but I'll go in and show all the relationships so you can see like what's changing versus credit, equity, Forex, commodities. Many of these commodities are very low volume, right? Red winter wheat comes to mind, right? It can be completely manipulated with just a couple of trades in the course of a week. I don't put a lot of stock in it. I don't trade it. For those that are and have the guts out there to trade grains, to trade any of the nat gas energy space, my hat's off to you. You'll never see me in that space. There's just too much potential for manipulation, especially in oil. I mean, they call it the widow maker for a reason. So I prefer, and there's plenty of other markets to trade. I like trading the euro US dollar, obviously. I like trading S&P over NASDAQ, but NASDAQ's close. Most of the reasons I just choose to trade the ES and the S&P is that they are liquid. The data I trust. They are not necessarily dependable, but they are predictable. The predictability of all this other stuff is a lot less. But I could be wrong. Let's take a look at euro US dollar. So daily chart, go all the way up to that top that I had mentioned, which essentially is just par. I was expecting us to, as we have in a dip in the dollar on a relentless rise higher, do keep in mind that even though the dollar is at these ridiculous levels, I think it is somewhat masking the fact that there is tremendous debt in this country, tremendous everything related to indebtedness and a sort of threat to the quality of the U.S. Treasury as a bond or as a credit instrument. But in the game of the better of less evils, the dollar has won out. But now we're coming back to a pretty interesting point, just like on the previous DXY chart. Now we're up against some pretty solid resistance right here. Be interesting to see if we can hold it. Pulled way back from it. Actually, keep in mind, shift these charts around more. It's hopefully more to just kind of show you guys what's going on without, I'm not really a drill down guy, but I mean, this is the edge of the cliff right here, 9.5 top, it's actually just under 1.01. Right now we're hovering basically at par, right? So if you guys are in the US and you're buying anything in Europe, as I just bought a French mountain bike a couple weeks back, make sure you're checking on the conversions. You shouldn't be paying any more or any less, in my opinion. Got any problems with that? You know, give customer service a call and shoot them a link to FinViz. And they'll see that there is no premium on this. It's dollar for dollar right now. First and only time in a long time. And it has been even. Let's take a look at the the UK with the Indian Prime Minister. I don't know what his name is. I forget. I should probably remember. I think he's actually a really smart guy. I mean, no surprise. Most of them all been. How much does everybody miss Tony Blair at this point, by the way? But hopefully they can get on track and on. You know, this was just an absolute abhorrent situation. Although if you're purchasing stuff, you know, this was, you know, and it, you know, for the purposes of U.S. and this is some of an impact. We saw this on our earnings. The fact that the dollar is so high, I mean, it is a U.S.-based company that does business globally. You know, you have all these headwinds of currency conversions when you're, you know, not necessarily repatriating capital back to the U.S. A lot of these multinational companies will have accounts all over the world, right? So they don't necessarily need to repatriate back and suffer any, you know, one way or the other. But it becomes very, very difficult from a risk standpoint as a global conglomerate when you're doing business. You know, I use Intel as an example. You know, they do business all over the whole planet, and you know, their currency desk looks like a hedge fund. And it's like a big operation, right? They're hedging, they're trading, that kind of stuff, you know, trying to, and the funny thing about some of these, at least in the old days before, you know, they sort of didn't have that as their mandate. In the old days, some of these, especially in energy area, their trading groups, they're more profitable than the rest of the business operations of the company, right? It's kind of crazy to think about. But I actually had this is a brief period of time, but we used to live in Philadelphia. We lived in a neighborhood, and the guy across the street was a trader for Pennsylvania Power and Light. And him and like 6 other guys ran the trading desk, an energy trading desk in Philly for, you know, a massive utility, right? And they did, these guys were more profitable than the rest of the utility. It was really funny. These guys got compensated insanely well for a short period of time. This is probably like 2004 through like 2008. I mean, these guys just made absolute bank in this group. And obviously all the bigwigs, as usual, figured out, hey, these guys are making more money than us, and crushed the group. So is capitalism. Let's take a look at the British pound. So I don't know, you know, at the time, anytime you see these whack reactions, you don't have like a solid auction that takes place down at the bottom. My whiff usually is we're going to go back down and visit that again at some point. But, you know, who knows with this? I think that, you know, we're getting a decent lift from better policy. We're getting a decent lift from the fact the dollar's pulling back. But just know this, you guys. I mean, right here, this is pretty much it. So we could rally back to that point. Hell, this could be it, right? But we could rally as high as this 117 number. I would pose pretty significant resistance up there in my point. Why? Because that's where we broke from the previous zone. See this break right here? Broke on slightly increasing volume, nothing crazy. Then we had our crescendo event, right? This is what you call watershed crescendo. I love these events because I usually know that price at some point is going to go back down to visit there. In some cases, price could not go back down and visit that area for years, right? But it is an incomplete auction. If you understand the concept of auction market theory, which I'm typically known for out there, although in my old man days of getting foggy with information, I seem to be needing to brush up more and more on my AMT and market profile, but incomplete auctions will always be revisited. I have not covered much currencies. Let's take a look at something else. I was going to go through these real quick. These are daily charts. You want to get rid of the noise, you can look at the weeklies, but got support right here, US dollar CAD. I would show the yen because it's been insane. Dollar Swiss. Again, rallies in these because dollar's pulling back, right? CAD JPY, Euro JPY. Now the Euro CAD from a weekly perspective, pretty solid resistance right here, 137. Euro pound, there's that exogenistic event, right? GBP CAD, here's a neo currency. Big rip. Why? Stronger rip in pound across the board. Let's take a look at this on a daily. Big and final area, also the top of the Bollingers, 1.5966 area. And we're rarely setting an actual price target. We're just more looking for a zone. Zones of congestion, zones that exhibit multiple areas of confluence, which is just a whole bunch of stuff lining up in one area, right? They pose much greater chance, potential for price to stop and reverse or stop and balance. Notice we're back inside the zone here. Long broadening balance area back inside. Same thing with the down under relationship. Spot gold. I tell you, my thought of what this should actually be doing, which is easy to filter out on a weekly chart, get rid of the noise. My thought of actually what should be going on here isn't. So what I do know, anytime we've rallied a bunch, it's been big sellers up here. It's probably large institutions just looking to dump maybe an over allocation to the metal. Could be other reasons, right? But we're holding here, and honestly, usually when you break a really important zone, yes, this whole area up here, this 16, essentially like the 1700 area, becomes a resistance, and you spend time under. I'm surprised this hasn't flushed, and I think a lot of that just has to do with a lot of times in risk management, you always need to assess what the ownership groups of a particular asset are. What does it look like? Who owns it, right? And I'm talking, forget about all those crazy television commercials with, William Devane and all the dudes on there. And it really has nothing, in my opinion, to do with the gold market. It's much, much bigger than all that crap. I am not against those that go out and buy bars of gold and stick them in their house. I'm only against the thought that if the world seems to come to an end, and as I joke often, how are you going to use a huge gold bar to negotiate your life? I don't know. Maybe you could negotiate your life with a big gold bar, but I don't know. It seems to me that it hasn't done much for you, right? All the gold bugs will point to, and I guess you could probably say somewhere in the area of 20 to actually, let's put this on a monthly chart. I've probably shown this way too much, but I know we have a lot of new listeners, so here's what the gold bugs will point towards. They'll point towards about this time right here when the price of gold just was going up a ton, right? Why was it going up so much? Well, this was looked at as a much safer asset class into the financial crisis, right? Financial crisis, really lasted for a while, right? The gold peaked, right? So had you bought somewhere in this arena, it took you 10 years to get back to flat. How is that an asset class you should have a large allocation to, right? Because you knew once we got into this, essentially this decline, there was just a ton of bag holders up here, like a ton. What happens when you have a decline? There's a ton of bag holders. One, well, they don't want to decline a lot, but two, it's going to take a long time to get back to high. What happened is we got back to the high. Many of those bag holders saw the price back up here and they sold. Happened again. They sold. Now, maybe we've washed everybody out. I find this is an asset class that continues to what's the best way to put this? What do you call it when you create like a mania that you just can't see? Here we go. Here's an asset class that just still to this day carries a high level of infatuation with it. Okay. Right. I mean, I've met people that have 100% of their non-real estate net worth in gold. And I always show them this chart. How has it done for you? They'll point back to this. They won't point back to the fact that has it done crap for them since 2011, and the stock of XYZ company, Nvidia, great example, right, has rocketed 9 times over. There's stories galore of those types of movements. So, I always say that from a risk management standpoint, and a lot of what I talk about in this cast has a lot to do with portfolio management, right? So, because I always think you should be diversified, obviously, but the difference between great returns and great managers over any decade or two is their ability to tactically adjust those allocations based on the market. Maybe it would have been heavy in gold coming into this point, but I certainly would have lightened up, and it would have made maybe 2 or 3% of a client's allocation, which is about where it is now. And that's really just for no other reason than a hedge. I don't think it's going to go up a bunch because we've already seen it, over what? And here's essentially the end of 2011, and every time we've cracked over 2000, there's been selling. 13 years of selling every time you get over there, right? Maybe all the sellers have been sold. Maybe it will go up and blast higher. But when you have a group, let's just call it a group of other time frame players I'd imagine there's a bunch of retail in here as well. But anytime, that our sellers up in an area, I just don't see how these prophecies of $2,500 gold are going to come and play out. Unless you can tell me decisively that we spend some time above 2,000, maybe like a month, and then actually buyers will come in, right? Believe it or not, it seems ridiculous, right? Because a lot of people are like, well, you want to buy low and sell high. Well, but if we went back to 2000, I'd probably still be a seller if I bought here, by the way. It's just a gold discussion only, just for the purposes, just because I come across an inordinate amount of people that have way too much in this area. And, they're usually the ones that are building the prep facilities and they got pounds of sugar in the storage shed and all that. I mean, look, I get it, to each his own, but you're caught up in your own mania and you have too much risk that the world's going to come to an end and you're in a protective mode, right? What are 15 guns and 10,000 bullets going to do for you, right? You can only fire so much before they actually come in and get you, right? Not sure you make it through 10,000 bullets. So, it just becomes a mania, right? And I'm not advocating for one or the other. I just think that if you're going to work your brains out and do well, that the investments that one makes should actually do something for you, right? Should actually make you money, right? ROI and IRR exist as metrics of performance-based for a reason, right? Use them. And that, my friends, is the podcast. Let's take a look at crypto. We can't be cryptoing over the crypto, and so let's take a look at what looks like my charts have gotten all screwed up. Here we go. Bitcoin, and you're looking at this on a monthly chart, doesn't look like anything. It's funny. But if you're looking at a daily chart, it tells a really interesting story. I think this is probably the longest period of time. June and now. Drop back to weekly. I guess. Yeah, I think this is probably the longest period of time that we've spent balancing before we go lower. So, if you're going to read the tea leaves on that, maybe we're due for a bounce. And maybe from a risk management standpoint, you look at these, by the way, these are weekly candles, folks, right? I would see this differently than some. And those, sorry, keep trying to adjust this around, but this is how I like to dice stuff up when I'm looking at it. And then on a full screen. So if you're a buyer somewhere around 18,000, right? It's critical that we get past this range. And we certainly can get up towards here, right? We get up to this area, the starry-eyed Twitter accounts are going to start to come out again. They're going to be claiming they told you to buy at 18.5, right? Remember why I said nobody's your guru? But we know where the edge of the cliff is. Remember what I said about big outlandish moves? And that, and this was a couple of large sells, obviously, probably more than a couple. Many will say, well, that was it. They'll come in and buy here. But look how close we've come to revisiting the scene of the crime. As I constantly point out, we're going to probably visit this bottom. What actually happens at this reactionary low will be a big tell, and the events subsequent to that will be a big tell for where I think price of this will go. Until we can see that, I think we're just mired in a sideways trade. So if we could see 17.6 and down here, maybe it doesn't hold, I think we're going to go a lot lower. And in which case, the true ashes of what I'm talking about in asset class destruction, and how sorting or sifting through those ashes for any sign of life can be a very fruitful endeavor as far as purchasing, right? Picture all the real estate at the bottom of the market in 2010, right? I don't care what region of the country, the hotter the market, more than likely the lower the price dropped. You know, a lot of people that came in and made a bunch of money in real estate, you know, buying, because since then, in some cases, prices tripled, right? We get back down to, you know, a much lower S&P, or in this case, the crypto discussion, a much lower Bitcoin, it may become something that I actually talk about wanting to own. But I prefer to sift through the ashes, you know, kind of like NVIDIA at 109. Things already up 30% on you, right? Sifting through the ashes is fun, right? Sometimes it's a fruitless endeavor. And it can be certainly fraught with lots of pain, but you know that you're getting in lower on a quality asset, which I'm not really sure I'd tag anything in crypto as a quality asset. But for more of a risky trade, it could be fun to ride it up. And with that, and over an hour in presentation today, I will leave you guys go. Have a great weekend. Everybody be safe, and may the trades be with you.